Have you ever stopped to wonder how a giant corporation, I mean a truly massive one, keeps track of every single dollar? We're talking everything from a multi-million-dollar merger all the way down to a single pack of pens. Well, the answer lies in this incredibly powerful, centuries-old system called the accounting cycle. Today, we're going to demystify it. We're going to show you exactly how this fundamental process powers literally every business you know. I mean, just think about that for a second. A global coffee company. The sheer scale is mind-boggling. But here's the crazy part. The answer lies in a system that's so elegant it can handle billions of transactions. But it's also so simple that we can understand the whole thing by looking at one small coffee shop buying its very first bag of beans.
So here's our game plan for today. We're going to follow the journey of that one bag of coffee beans step by step through the entire accounting cycle. We'll start with the one golden rule that holds it all together, see how it gets recorded and organized, checked for accuracy, and then finally, how it all helps paint the big financial picture. All right, let's dive right in with the absolute foundation, the one concept that makes this entire system work. And it's an idea that's actually kind of borrowed from physics. For every single action, there has to be an equal and opposite reaction. And that's it. That is the core secret. Every single financial event, no matter how small, affects at least two different accounts. This is what's called the double entry system. So if a company's assets, the stuff it owns, go up, then something else, like what it owes or what the owners have put in, has to change too. It's an engine of perfect balance that makes sure the books are always, and I mean always, in check. This slide just lays it out so perfectly. Forget all the complicated textbook definitions for a minute. Let's just think about our coffee shop. What did we get? We got coffee beans. That's a debit. It's where the money went. Now, how did we pay for it? We used cash. That's a credit. It's where the money came from. One side goes up, the other side goes down. It's a perfect, self-balancing seesaw. Okay, so we've just bought our coffee beans, we get the whole debit and credit thing, but where do we actually write this down for the very first time? Well, that brings us to the first official step in the cycle. This is where the journal comes in. It's basically the starting line. Think of it as the business's diary, where every single transaction gets captured the moment it happens, right there in chronological order. So when we buy our coffee beans on Monday morning, that's exactly where the story begins, on Monday's page in the diary. And to stop that diary from just becoming a total chaotic mess, businesses use all these specialized journals. They're often called the books of prime entry. All the cash stuff goes in one book, all the sales in another, all the purchases in a third. It's kind of like having separate notebooks for your income and your expenses. It just keeps everything neat and tidy right from the get-go. So our diary is great. It's awesome for knowing when things happened. But what if we want to know, say, our total cash on hand, or how much we've spent on coffee beans for the entire month? Just reading a diary from cover to cover isn't exactly efficient, right? We need to organize all this information. And that's where the general ledger steps in. If the journal is the diary, the ledger, well, that's the master filing cabinet. Every single entry from our diary gets posted, which is really just a fancy word for copied, into a specific file in that cabinet. So the cash part of our transaction goes to the cash file, and the coffee bean part goes to the inventory file. Simple as that. And sometimes you need even more detail. That's where subsidiary ledgers come in. Think of it this way. The general ledger is your entire phone's contact list. A subsidiary ledger is like the family group you created within that list. It gives you all the specific details, like what each individual customer owes you, without cluttering up the main view. Okay, we've recorded everything in our diary. We've organized it all into our filing cabinet. Now, before we can actually do anything with this information, we have to perform this really crucial checkup, just to make sure we followed that golden rule of balance all the way through the process. And this, my friends, is the moment of truth, the trial balance. What we do is take the final balance from every single account in our general ledger and just list them all out. All the debits go in one column, all the credits go in the other. Then we add them up. We're literally putting everything on a giant scale to see if our accounting truly balances.
Let's look at a super simple example for our coffee shop, The Daily Grind. As you can see here, we started with $2,000 in owner's capital. That's a credit. We then spent $100 on beans. So our cash account is now a debit of $1,900, and our coffee beans inventory is a debit of $100. Now look at the totals at the bottom. The debit column adds up to $2,000, and it perfectly matches the credit column. Boom! The system works. We are in balance.
So we've proved our numbers are balanced. Awesome. But so what? What's the point of all this? Well, all of this recording, organizing, and checking has been leading to one ultimate goal: transforming all this raw data into a clear story about the company's health and its performance. This slide shows the whole shebang. We've covered recording in the journal, organizing in the ledger, and checking with the trial balance. Now, right before the final step, accountants make a few adjustments, little tweaks to make the numbers more accurate. And all of this leads to the big payoff, creating the financial statements.
And this is why the entire cycle matters so much. All that carefully balanced data gets funneled into these super important reports, like the income statement and the balance sheet. These are the documents that actually tell the company's story. Are we making money? Are we financially stable? They're what turn raw numbers into the intelligence you need to make smart strategic decisions. So there you have it. We've followed one tiny little purchase of coffee beans from its very first entry in a diary, through a super organized filing system, to a crucial balance check, and finally saw how it becomes a key piece of the company's entire financial story. But this leaves us with a really fascinating question, doesn't it? The entire system is built on this perfect logic of balance, a self-checking mathematical loop. So if the math is always designed to add up, how on earth do we hear about things like creative accounting or major financial scandals? How can a system that's built on perfect balance be manipulated? Well, that's a much deeper story, and maybe one for another day.